Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Electoral College votes to seal a return to the White House. Jay Pelosky of TPW Advisory is back with us. He was with us, 6 hours ago, Jay? It's good to see you again.
It's nice to see everybody.
I feel so bad to start with this, but you made a really bad call on this election. Harris landslide. What went wrong?
Well, thank you, John. I appreciate that. It's a nice way to start the conversation. Always love that.
No elephants in the room here.
Well, look, right? I mean, my thought is it's a good thing we're not paid to be political prognosticators because we were of the view that the Democrats would win. Women vote, abortion, youth vote, etc. None of that really materialized. And what's really interesting after a few hours of sleep is the idea of good economics has turned into bad politics for the Democrats, right? The Biden-Harris administration, best economic outcome in generations. The U.S. is the envy of the world, best growth, lowest inflation. And the Trump policy mix, which I think economically speaking is going to prove to be not very good, but was clearly good politics. And so as an investor, here we are sitting. We need to think about exactly what we just discussed. You know, is it going to be a sweep? Because that means the policy mix, more of it is likely to materialize. If it's not a sweep, then we'll see how it all plays out. But I think for us at TPW, we're focused on a long cycle opportunity, good global growth, good risk asset opportunity, and a lot of that depends on policy continuity. And I think what we're going to have in the U.S. is clearly policy discontinuity, and the question is going to be, how does that play out? And the setup I'm thinking about, like right now, this morning on the way in here, was you have the U.S., which is an over-owned, expensive asset. Foreigners have never owned more of U.S. financial assets at a time when the policy mix is deteriorating versus, for example, China, which is a cheap asset, under-owned, just to finish, cheap, under-owned, and arguably the policy mix is improving. City Economic Surprise Index turning up, PMIs above 50. And I think we're going to see at the end of this week a further policy response by China because they understand that their growth right now is export driven. And with tariffs, that could be a big problem.
I wasn't trying to interrupt you, but before we get to China...
I don't like that.
Don't interrupt you.
John can criticize me. But no interruptions.
He hasn't slept. I've wound him up. So ready to go.
It's okay.
All right, it's a third down or fourth down. How much do we need to get?
There's a question.
Give me the ball.
There's a question here about whether you then fade this move. If you believe that actually this is not the right policy, do you put your money where your mouth is?
Well, that's a great question. And I thought about that, and tactically, I think you have to enjoy the bounce, right? And the reasons are multifold. First, seasonality. This is the best 3 months of the year for stocks. Positioning is pretty light, right? You're seeing that play out. Right? You don't have 5% moves, 2% moves in the S&P if everybody's already long. So people de-risked. Now they have to re-risk. Technicals are supportive. And importantly, most importantly, fundamentals are supportive, right? We're just coming out of Q3 earnings. They were double what the expectation was going into the earnings season. The projection was 4%, ended up being around 9%. And most importantly, I think we've seen a complete collapse in the VIX. That's what needs to be up on these charts here for Bloomberg, right? The VIX has gone from 25 to 15 in a matter of hours.
2 hours on TV last night. He's producing now.
I need a new job, John.
I want that up on the screen. Let's go.
I need a new job.
He's out of political forecasting. He's producing.
Yes, exactly.
You got some sleep.
Something's got to work.
Now you think you could just take over. So your tripolar world, even though your political conviction was wrong, your market conviction, in a sense, was accurate.
Yep, exactly, which is, it goes back to what I said last night. Remember my mea culpa, I think it was 12:50 last night, was, look, do you want to be, the old market saying, do you want to be right or do you want to make money, right? And I struggled with that for years because my background is a sell-side strategist, and so you want to be right. Really important as a sell-side strategist. As an investor and an advisor, we want to make money. And so we're fully invested. We're long equities. We are completely out of Treasury, so this Treasury move is not affecting us in any way, shape, or form other than helping us beat our benchmark.
What would it take to get back in?
Yeah, that's good. That's, again, the question to be asked, I think. And, it's a little tempting tactically, again, because as I said last night, going into this week, the long end of the Treasury market, as represented by ETFs, was massively oversold, right? The RSI, Relative Strength Index for the 7 to 10-year ETF, IEF, was 15. They don't really get down around 15 very often. So tactically, I think you're probably, I wouldn't be a seller if I were as an owner of Treasuries right here, the long end. But I think the bigger question is the deficit. And clearly, again, the Trump policy mix, it's not just my point of view, pretty much every independent person who looked at it or group, Moody's, Goldman, Peterson, et cetera, it's bad for inflation, it's bad for the deficits, bad for rates, and theoretically should be bad for growth. But I think there's an idea that this is going to be a hothouse effect, which is what you guys have been talking about.
So what are you looking for to decide whether or not to bite the bullet, sell stocks, buy bonds?
Yeah, part of it is to see the makeup of the house. Is it a trifecta? Part of it is to kind of like see what China does, right? Because there's going to be a response. Well, we're global, we're multi-asset. So we have the whole world as our oyster, and there are going to be opportunities to play. I think for now, as I said, we enjoy the bounce, we enjoy the ride, and we think about at some point maybe lightening up. I think for the U.S., I think the call for us is going to be, if we really do believe in the tripolar world, competition between China, the U.S., and Europe. China has taken the high ground in the clean energy space. Trump wants to end EVs, et cetera. The real fight now is AI. And I don't see that this is, the two countries are separating their tech stacks. That's our whole thesis with China tech. And, I think the issue right now is, do you want to press that bet, right? So you reduce the U.S. And you go further into Asia, which has been down 5 weeks in a row, is cheap and under-owned. Those are the things you want to play.
As you say, he wants to end EVs. Tesla's absolutely soaring today.
Well, that's the Musk thing.
Who do you think is the biggest loser in terms of your tripolar world with this composition we see in Washington?
The U.S., clearly, because Europe has got to respond. They know that. The whole Draghi report on competitiveness was we got to do more of the things that China and the U.S. are doing. And to us, there's a new industrial policy mix that is being implemented around the world. To compete in AI, to compete with climate mitigation, to compete in conflict, you need public-private partnership because it's too much money for the private sector alone, and the public sector doesn't have the expertise. So who can marry that best is going to be the winner. And I think you also have to think about immigration. Who can leverage the immigration to improve their growth profile is also going to be a winner. And in the policy mix that the Trump team has laid out to date, it's anti pretty much all of that. And so, strategically, as I said, the U.S. dollar is the most over-owned. It's expensive. And the policy mix, in our view, is deteriorating.
There's a lot to unpack there. I just want to pick out a few things. The former president, now president-elect, has been quite clear that he wants national champions, which is why there's the proposal on the campaign to drop the corporate tax rate to 15% with conditions for domestic manufacturing. Now, you said, when asked who's the biggest loser, you said the US, and then you said clearly. Mm-hmm. It's a clearly piece of it that I'm going to push back on because it's not so clear to a lot of people watching the program right now. Sure. You acknowledge that at the moment, I think you called it a hothouse theory right now in America. That's what it feels like. It feels like if you're investing in America, you'll do well. If you're trying to export to America, you might have a problem. That hothouse theory, what's the biggest hole in the window right now?
Well, I think it's J.P. Morgan who laid out the case that if Trump implements the 60% tariff on all China imports, that will lead to almost a halving of the earnings growth that's expected for 2025. In other words, the earnings are expected to grow by about $35 next year from this year, 25 to 24. The tariff effect will carve out $15. This is J.P. Morgan's estimates. They got, reams of economists thinking about this stuff. And so you're basically talking about taking your earnings growth and halving it. At a time when, you're not going to get multiple expansion. So it's all about the earnings growth. Year 3 in a bull market tends to be the year of rest. We are going into year 3. That's historically the case, typically single-digit returns. And so I think that the idea of national champions, sure, that's why Tesla's probably rocking. Musk is going to be one of the national champions. But I think overall, the whole thrust of the U.S. policy mix has been reshoring, right?
Got it.
And reshoring with a dollar getting more expensive, those two things don't compute. So that's a big hole in my view.
I'm going to suggest those JP Morgan economists aren't too unhappy this morning. The stock is up by 6.5% in the pre-market. Jay, it's good to see you.
Likewise.
And seriously, appreciated your time overnight and this morning.
Yeah,
Thank
it's
you,
been great. I mean, one of the things that's great about this is that you have to think in real time. Right, so by coming on and engaging in this debate and dialogue, it makes our process better, and so we appreciate it. And good luck to everybody, and hopefully the next time we see each other, we'll all have had a little bit more rest.
We'll see you soon.
Yeah,
Jay,
exactly.
Thank you, sir. Jay Pelosky there, TPW Advisory. Attention turning to the Fed rate decision. Torsten Slok of Apollo expecting a 25 basis point rate cut, adding, quote, "We don't expect the Fed will cut interest rates in December." Torsten joins us for more. Torsten, good morning.
Morning.
I'm not sure if you've been to bed, so let's start with the election. Good night, good evening, wherever you want to go. I want to understand whether this has changed anything for you or just cemented what you were already thinking.
Well, I think, of course, what always comes with elections is that now we need to figure out what policies are actually going to be implemented. It's clear that yesterday at around just before 9 p.m. we found out what the Trump trade really was, namely that rates were going higher, the dollar was going up, and stocks were going up. So from that, of course, we can derive that, well, if this continues, it does, on the one hand, mean easier financial conditions because of the stock market going up, but it also means tighter financial conditions because long rates are going up. So now the challenge for markets is to figure out, why are long rates going up? Are they going up because of the economy expected to be better, or are long rates going up because of worries about fiscal sustainability? And this becomes a very important debate, namely what will the term premium, meaning what will happen to the part of rates that in long rates that have nothing to do with Fed expectations. So therefore, the conclusion is that we still need to wait and see what policies actually will come.
Which one do you think it is and why? Where's the tell?
If I look at my Bloomberg screen and the term premium coming both from the San Francisco Fed and the New York Fed, they both say that the term premium in the last 6-7 weeks has been going up more than 50 basis points. So that's telling you that rates in the long end are going up for reasons that have nothing to do with Fed expectations. So now it becomes therefore a little question about, okay, so if rates are going up for reasons that have nothing to do with Fed expectations, what could those other reasons then be? And traditionally, one interpretation has been that markets do focus on fiscal sustainability. And given that both candidates have been scored by the Penn-Wharton budget model and the Committee for a Federal Responsible Budget, that we will have more deficits both under Harris and under Trump. One interpretation has been that rates have generally been going up in the last month or a little bit more because of renewed worries about the fiscal situation.
That said, this morning what we're seeing is small caps ripping. What we're seeing is some of the consumer cyclical stocks ripping. Some of the lower rated credits actually doing very well, which actually flies against this idea that it's going to be tighter financial conditions that constrains the economy. Instead, it suggests something about growth reaccelerating. Are you saying that this is an inconsistent response from the market, or can you take that as sort of a signal here?
Well, for small cap in particular, absolutely rates higher for longer is negative, because let's remember that 40% of the Russell 2000 have no earnings or negative earnings. So that means the Russell 2000 companies are characterized by having low coverage ratios, meaning very little earnings to pay for the interest payments. So that's, of course, negative for small caps. What's positive for small caps is likely, first of all, we may get now get more growth, but also from a regulatory perspective, if we now have that the Republicans are going to, at least as the market textbook would say, create an environment that is, in the market's language, more business friendly, well, that would also be a reason then why small caps should now be benefiting. So there's a tug of war going on between tighter financial conditions, meaning higher interest expenses, and at the same time, what could be characterized more tailwinds to the business environment.
I'm trying to get my head around this because I want to understand how the Fed's going to grapple with this tomorrow and how Fed Chair Jay Powell is going to signal about yields going higher on the long end that ostensibly should be tightening financial conditions, but aren't, if you see ISM services like what we saw yesterday, but aren't if you see what we're seeing in the employment market. At what point does it become a concern? What are the red flags to you?
Exactly. So that's why tomorrow is easy for the Fed. December is really difficult because now we get to the very difficult situation that we already, even before the election, had ISM services going up really significantly, including the employment component. We've all been assuming now for several quarters, employment is slowing down, non-farm payrolls will gradually weaken, but then suddenly we began to see, of course, in September, non-farm payrolls went up, October was distorted by the weather, but if we get a payback from the weather in here, the data for November, and on top of that, we're already seeing ISM services for employment also going up. The challenge for the Fed is that both organically, if you will, the economy is actually still in a good spot, and now you have some questions about, well, what type of policy will come? Will we have more fiscal policy? Will we have, therefore, more support to the economy? That will then become the challenge for them in terms of what they should be doing in December.
Well, Torsten, the highly regarded Cook Political Report just put out a note saying the most likely outcome now is a GOP trifecta. Former Speaker of the House, Kevin McCarthy, just texted me saying the Republicans will keep the House. This is someone that knows the House very well and also knows those California districts very well. So if there is this trifecta, what policy can actually get done?
Well, so now we go all back and look at the Penn-Wharton budget model, which had a quantification of what would be the implications for GDP of the potential here of a red sweep. And the answer to that is that we will generally see a boost to the economy. We will probably also see some boost to inflation, which will certainly complicate the Fed's job. So that's why it remains to be seen what of the things that Trump has talked about he will be implementing. But if we do get a red sweep, then certainly we should be going back and studying hard what has the quantified models been showing in terms of the implications for the economy.
How does Jay Powell talk about this tomorrow?
Well, it's a very difficult challenge for him here because obviously if we agree that tomorrow is easy with 25 basis points cut, then how do you start to talk about including this in your forecast? I think that one way that he might begin to talk about it is to say, well, we just don't know what exactly will happen. We don't know which of these policies will be implemented. So we have a list of things that Trump has talked about, and they have all been quantified by a number of different institutions. But what of these things will actually come through and in what order of magnitude becomes a very important issue, of course, for the Fed.
We can play around with this a little bit. Does anyone start auditioning to take Chairman Powell's job?
Well, as we all know, his term will run out in May of 2026. So now we will already begin to have in the second half of next year a debate about who should be the next Fed chair. And of course, this will also become a very important part of discussion in markets.
We're going to have it right now, aren't we? Doesn't that debate start right now?
100%, especially because what we were talking about with Thomas Honig, I think we cannot emphasize enough. The tools that the Fed has are not just cutting rates. They also are quantitative easing. They also are bond purchases at a time where there's a real question about the long end. And I wonder how long before we start talking about that.
Torsten, just one final question. How similar is this to 2016 when we were waiting for the tax cuts to come from the Trump administration? And we're having similar conversations with Fed officials. I remember the news conferences. I remember the Fed speakers at the time. It was, at what point do you start to bake this into projections? And they had to wait until it became reality. Is it much worse than that? Is it the same? Do you see some parallels here?
This is very different because at the time we had two policies. We had lower taxes, the TCJA, the Trump tax cuts, and then we had at the same time tariffs. Now, we don't have significant tax cuts, at least not of the same magnitude. So if the tariffs are now going to be even bigger than what we had in 2017, then you can begin to wonder, well, if we don't have the offsetting effect that tariffs will, generally speaking, lead to higher prices and, generally speaking, the risk of lower sales, there was an offsetting positive effect to the lower sales part by the tax cuts, and we don't have that magnitude of tax cut potentially. There are some suggestions that he's talked about lowering corporate tax rates to 15% for domestic manufacturers, so that could maybe offset some of it, but given what we're talking about on the tariff side is so much bigger than what we had with 60% on China, than what we had in 2016, that means that the risks are more tilted towards tariffs potentially playing a bigger role.
This is the beginning of a much longer conversation, but just a final word. 2025 rate hikes? You ready to go there?
Well, if we now get a tailwind to growth from a better business environment, from easier fiscal policy, and we might also have a little bit higher inflation because of tariffs. If we deport illegal immigrants, that might also be lifting wage inflation. That would all be arguing for the Fed definitely not cutting as much as the dot plot is telling us at the moment.
Torsten Slok of Apollo, one of the very best. Isaac Boltansky of BTIG joins us now. Isaac, welcome to the programme. We've got some time to work through some of what we've learned overnight. What went right for Trump and what went wrong for Harris?
I think it's going to take a lot of time for us, and I think that there are going to be a number of postmortems on this. In talking to Democrats, I've already heard a fair amount of focus on The economy, obviously, that's the number one issue. That's what they're starting to see from the exit polls. But they're also claims and concerns of misogyny and other issues that are in play. And so I think Democrats are going to have a lot of soul searching to do, John. And this was a resounding shellacking that they received last night. I mean, when you go through some of these numbers, it's pretty staggering. Trump expanded on his previous margin in 2,300 counties. He only decreased his margin in 240 counties. That's absolutely astounding. Just the fact that he won the popular vote is something that I don't think many of us had anywhere near our bingo card. So I think for Democrats, they're in the wilderness right now, and I think it's going to be a long few years before they figure out who their new standard bearer is and what their message is.
Well, when it comes to the standard bearer of the Democratic Party, the sitting incumbent president, do you think the fingers are really going to be pointed at him right now, or is it the VP?
I think that we're going to have a circular firing squad in the Democratic Party for the next few days. I think that everybody is going to have to eat a little bit of blame for the strategy here, and realizing also that there was a tough hill to climb here. Right. And I think that we're going to have a lot of revisionist history in terms of when we should have had Biden exit, if we should have had a full primary. All of those things are going to take up a fair amount of time and air within the Democratic community. The question to me is, are they going to be able to govern from the House, or are they going to be in a minority there as well? That's the biggest question for me, and I think everyone else at this moment.
What are the tea leaves telling you about those House races right now? There's some dozen or 2 dozen we're still waiting to hear from.
Look, all of my Republican contacts are optimistic, but that might be just the broader euphoria that they're feeling this morning. It's going to take 2 or 3 days. We're going to have to buckle in for this. Ultimately, I think what I've tried to highlight to clients over the past few months is no matter who's in control of the House, it's going to be a very slim margin from the looks of it. And you're going to have the same dysfunction that we saw with the speaker fight just last year. And I think that's going to be a theme that markets are going to have to deal with, especially as we get to some of these big ticket spending efforts that I think we all care about.
Isaac, just to build on that, I think is one of the big questions in markets this morning. We were just speaking with Marvin Lowe, for example, who was saying he thinks right now the bond market and broader markets in general are pricing in just Donald Trump at the top of the ticket and the Senate turning red, not a red sweep. What are you hearing from clients about how much you could get a very much accelerated move on the idea that those 19 still undecided votes that could flip the House do go the way of the Republicans?
Yeah, look, it's a huge procedural issue, right? If you have Republicans in charge of the House, you're able to use budget reconciliation, which is an incredibly powerful tool, as we all know. And I think we would have to change some of our assumptions at that point regarding what will be spent over the next 2 years. And so to me, if you have that red sweep and that's confirmed over the next few days, then I think our deficit assumptions are going to have to be ticked up a bit because of the budget reconciliation process. And so to me, that's the ball game at this point when we think about it. A lot of what we're going to do over the next few days is separating rhetoric from reality, right? How much of his immigration proposals is he going to advance? How much of his tariff proposals is he going to actually advance? But on the spending side, the most important issue here is, do Republicans have control of the House? Because that unlocks budget reconciliation, and that's incredibly powerful means of advancing your agenda.
There's been a lot of discussion around who Donald Trump would surround himself in the White House, who his cabinet would be, what kind of tenor it would be, whether it would be hawkish, whether it would be dovish when it comes to foreign policy, when it would be more expansionary or hardline or not. Do we have any early indications based on who was with Donald Trump last night, who he is surrounding himself with early this morning?
I found it interesting that we saw the return of his daughter and his son-in-law to the stage. I think that's not something that we've seen recently on the political side. So I think that's noteworthy and is something that we should continue to track. I think you're also going to see the return of other folks who have maintained their place in the orbit, whether that's Steven Mnuchin, or you're going to hear a lot more from Robert Lighthizer, who I think we're going to have to keep our eyes on for Treasury Secretary. Those are some of the names. I think that there also is going to be a pronounced focus on Wall Street. Look, John Paulson is part of this conversation, for example. You've seen a number of other hedge fund managers who I think are going to have the ear of the president. I don't have the answers at this point, but I know that those are some of the names that you're hearing mentioned most frequently.
Isaac, appreciate your time, sir. As always, no doubt we'll be talking again soon. Isaac Boltansky there of BTIG.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.